Good morning, esteemed investors. I'm LaShawn Fofon, the founder of FO Tread Bikes. We are a custom 3D carbon fiber bicycle startup that I funded through our initial growth phase. Today, I'm excited to share our proven business model and demonstrate why a strategic 2.5 million equity investment will accelerate our trajectory, revolutionize the cycling market, and deliver significant returns. To achieve this vision and deliver on our promise, let's first delve into the core of our business, our mission and strategic objectives. At FO Tread Bikes, our mission is to deliver a top tier, elite, and affordable cycling experience to all riders. We achieve this through our proprietary 3D printed carbon fiber technology, which empowers cyclists at every level to conquer their goals with unparalleled excellence. Our strategic objectives for this investment are clear: to achieve profitability by quarter 5, significantly expand our market presence, and elevate our brand judgment within the industry. Our strategic approach to achieving these objectives is grounded in a clear understanding of the market, specifically through our targeted segmentation and product line expansion. Our strategic focus is on 3 high-growth cycling categories, which are recreation, speed, and mountain. In quarter 2 and 3 of our test market phase, we prioritize the recreation and mountain segments, successfully building a strong foundation with our current portfolio, which includes popular brands like CF Vector, Aerial X, and CF Vector. Both of these are in our current target market from quarter 4 and beyond, which is recreation and speed. Based on evolving market insights and demand, we made a strategic adjustment in quarter 4, shifting our priority to the recreation and speed segments. This allows us to optimize our market penetration and directly address emerging demand. Critically, our tactical plan includes the introduction of 3 new 3D printed models in quarter 6, such as the CF Vector 3, Aerial 3, and the Mountain 3D. These innovations will significantly diversify our offerings, capture additional market share, and ensure sustained competitive advantage across these key segments. Now, let's review our performance within these targeted segments during the test market phase, examining the crucial insights gained from quarter 2 and 3. Our market performance from the test market phase provided crucial insights into market dynamics. In quarter 2, FO Tread Bikes achieved a significant 41% market share, demonstrating our strong initial market entry and product appeal. Our quarter 2 ads, which received an acceptable IAF ad copy rating for our recreation and mountain segments, contained about 6 to 7 benefits, which contributed positively to this performance. Despite mountain bikes having the least segment size in quarter 2, we made a brand design adjustment with the introduction of Flow Mount 2 to capitalize on the segment low entry barrier. In quarter 3, while our overall market share adjusted to 18%, this presented a valuable learning opportunity. This adjustment was a direct consequence of 2 key decisions and their immediate impact. These decisions were: first, having less effective quarter 3 ad design strategy, and secondly, the introduction of Flow Mount 2 in response to defects with carbon fiber rugged frames in our mountain bike brands. The first decision, our quarter 3 ad design, suffered from a less effective layout that removed key customer benefits, thereby negatively impacting demand and brand ratings, as none of our ads met minimum requirements for our targeted segments. The second decision to introduce Flow Mount 2 in Q2 combined with emerging concerns regarding the durability of our rugged bike frames for extreme mountain biking. This led to significant ill will penalties in Q3, specifically for models like Flow Mount 2, about 19 units, and affected demand and brand rating in the mountain segments. To recap, while the company demonstrated a strong Q2 market entry with 41% market share and effectively addressing initial stockouts, Q3 performance saw a market share adjustment to about 18%. This was primarily due to two key decisions: a less effective Q3 ad design that removed key customer benefits, and an underlying durability issue with rugged bike frames, especially impacting the new Flow Mount 2 model, which resulted in ill will penalties and reduced customer confidence in the mountain segment. These insights were immediately leveraged to refine our marketing and operational strategies for Q4 and beyond, positioning us for sustained growth and market recapture through targeted product improvements. To provide a more granular view of our initial market penetration, let's analyze our Q2 demand dominance across specific bike segments. Demonstrating initial market capture, our Q2 demand clearly illustrates our early market capture. We commanded 31% of the recreation bike demand, 50% in the speed segment, and a dominant 58% of the mountain bike demand. This indicates strong market fit. Following our strong Q2 performance, Q3 brought shifts in demand across segments, which led to important strategic adjustments and competitive insights. In Q3, our recreation bike demand decreased to 16% and speed bike demand to 17%. These drops were significantly influenced by our Q3 ad design decision to use a less congested layout, which regrettably removed relevant customer benefits and resulted in ads that did not meet minimum requirements for our targeted recreation and mountain segments. More critically, the mountain bike segment saw a steep drop to 27% from 58% in Q2, a direct result of growing concerns about the durability of our rugged carbon fiber frames, particularly impacting the Flow Mount 2 model, which incurred an ill will penalty of 19 units out of 118 generated demands. This issue significantly impacted brand ratings and customer confidence in this segment. These shifts, particularly the rise of competitors like Bike 3D and Mountain, have informed our tactical adjustments for Q4 and beyond, including product innovation and targeted marketing to recapture and expand market share. Beyond market demand, our sales performance provides a clear picture of both initial growth opportunities and our operational efficiency. Looking at our Q2 and Q3 data, we've identified growth opportunities and we were able to highlight unmet demands. Our Q2 sales performance reveals critical insight. We generated over $505K in sales revenue from selling about 387 units, achieving a gross margin of over $285K. However, we experienced 183 lost sales due to stockouts. This signifies substantial unmet demand, underscoring the immediate need for capital to scale production and prevent future lost opportunities. Our strategic decision to significantly increase production capacity following quarter two directly led to a quarter three sale performance turnaround, demonstrating scalability and efficiency. We successfully increased our total net demand to 659 units and crucially eliminated all lost sales due to stockouts. This directly resulted in over 1 million in sales revenue, a substantial gross margin of over 686K. This performance demonstrates our ability to not only meet demand but also to scale profitability once production capacity is addressed. However, despite this operational success, our quarter three ad design decision to utilize a less effective layout and remove key customer benefits limited our potential financial gains by negatively impacting overall demand and market share, as detailed in our previous slides. Highlighting quarter three financial strength and operational excellence, we achieved the maximum scores in cumulative total performance of 1.315. Our cumulative financial performance was 14.187, and our cumulative asset management score was 0.411. Furthermore, our cumulative financial risk stands at a perfect 1, underscoring our resilient financial health and discipline management. The past financial performance of FO Tread Bikes was significantly shaped by two key decisions. First one, a strategic reinvestment of capital and production capacity, and secondly, opening new stores and less effective ad design strategy in quarter three. These resilient financial outcomes were directly influenced by our strategic decision to consistently reinvest capital into the business from quarter two to quarter four, notably increasing production capacity and opening new stores. This significant investment is reflected in our soaring sales revenue and gross margins in quarter three, and the elimination of lost sales, which contributed to our high cumulative financial performance and cumulative asset management scores. However, our financial performance, particularly in terms of maximizing potential revenue, was also impacted by the quarter three ad design decisions, which, as detailed in earlier slides, curtail overall demand and market share. To capitalize on these opportunities and mitigate any identified threats, we have meticulously crafted an investment plan designed to fuel our future growth. We are allocating significant capital to R&D, system improvements, advertising and marketing, and employee compensation and benefits. Allow me to provide a detailed breakdown of how the strategic 2.5 million equity investment will be precisely allocated across our critical growth areas. The 2.5 million in equity funding we are seeking will be strategically allocated to accelerate our growth and fully bring our products to market. This investment will be distributed across four critical areas. Approximately 2.9 million will be dedicated to R&D, 2.1 million to system improvements, 624K to advertising and marketing, and 88K to employee compensation and benefits. Our R&D investment will focus on advanced carbon materials, wet and dry carbon ceramic disc technology for superior lightness and strength, and puncture-resistant tires, cutting-edge performance by computers. System improvements will target environmental actions, worker training, quality control, strengthening supplier relationships, health and safety, and fostering positive community relations. These are crucial for long-term sustainability and efficiency. In advertising and marketing, funds will enhance media placement, improve ad content, increase paid SEM, and boost social media interactions, directly driving demand. Finally, increased employee compensation packages are vital to reducing turnover, improving morale and productivity, and enhancing our company culture, a direct investment in our human capital. A key component of our investment strategy and crucial for market penetration is our aggressive marketing plan and increase in production volume. Our marketing strategy is designed to establish a dominant market presence. We are aggressively increasing our advertising budget and internet marketing expenses across all quarters. Key initiatives include major ad placement in quarter four and the strategic launch of 3 new ads and 3 new brands in quarter six, signaling our continuous innovation and commitment to market leadership. Beyond attracting demand, our ambitious sales channel strategy outlines how we will expand our global reach and drive significant revenue growth. We have opened stores in key international markets in New York City, Amsterdam, Bangalore, and Rio de Janeiro. We project a dramatic increase in demand, with projected demand rising from 659 units in quarter three to 3,630 units in quarter six. This translates to projected revenue surging from over 1 million in quarter three to over 5.3 million by quarter six, showcasing a clear path to significant top-line growth. To ensure the successful execution of this expansion, our strategy includes strategic staffing and focused global market penetration. To support this aggressive growth, we are increasing sales and service employees in quarter five to fully staff our Rio de Janeiro store and providing additional staffing to all open stores. Our global market penetration strategy focuses on establishing a strong physical presence in these critical international hubs, ensuring we capture market share effectively. Central to fostering this aggressive growth, and indeed our long-term success, is our comprehensive human resource strategy focused on cultivating a high-performance culture. We provide comprehensive employee compensation and benefits, including competitive salaries, vacation, pension, and medical, specifically designed to decrease employee turnover and improve morale. We are also investing heavily in employee training, encompassing cross training, department specific training, and team building. Additional benefits like daycare, a fitness center, a health clinic further enhance employee well being and productivity. To meet the projected demand generated by our expanded market presence, our manufacturing strategy is meticulously designed for optimal efficiency and capacity. We have strategically added and invested in fixed capacity through quarter four, significantly increasing our available and operating capacity. Our goal is to drastically reduce lost capacity due to production productivity, aiming for a mere 5% by quarter six. This focus on efficiency is coupled with increased production volume. This will continuously drive down our average unit production costs and improve our margins. All of these operational strategies are integral to our overarching financial strategy, which is centered on maximizing returns for our investors and ensuring long term sustainability. Our current financial structure is deliberately debt free, with no conventional bank loans, emergency loans, or CDs. This strategic choice minimizes financial risk and reflects our reliance on equity financing to fuel aggressive growth. Analyzing our financial statements provides detailed insight into this strategy through our key financial ratios. Our gross profit margin remains resilient, standing at 65.8% in quarter four. We use this to calculate by our gross profit of over 1.6 million and revenue of 1.63 million. This demonstrates strong product unit economics and efficient cost management at the production level, indicating our core business model is highly profitable. While our gross profit is strong, our net income for quarter four is a little over negative 1.53 million, resulting in a net profit margin of negative 93.62%. As calculated with our net income of 1.53 million and revenues of over 1.63 million. This negative margin is a direct and intentional outcome of substantial strategic investments in research and development of 1.12 million in quarter four and system improvement cost of 770K in quarter four, which are foundational for future profitability and market capture rather than immediate bottom line gains. Our debt to equity ratio stands at 0. Being that we have no total debt and our equity is a little over 295 million as of quarter four. This underscores our commitment to a low leverage model, prioritizing substantial growth and investor security through equity-based financing. Our liquidity is exceptionally strong with a current ratio that is effectively undefined or extremely high due to significant cash reserve in quarter four and no current liabilities. This ensures we have ample short-term funds to meet operational needs and pursue growth initiatives. In terms of industry norms for high-growth manufacturing startups such as ours, our financial strategy prioritizes aggressive investment in innovation and scalable infrastructure over immediate profitability. This equity-funded approach, reflected in our current negative net income but growing asset base and a strong cash reserve, is common in a disruptive industry where market share and technological leadership are paramount. Our focus is on resilient growth metrics, as demonstrated in our long term potential for investors' return. Our perfect cumulative financial risk score of 1 further reinforces our commitment to a low leverage model, prioritizing sustainable growth and investor security through equity based financing. This overarching strategy involves maximizing available cash, actively seeking venture capital investment such as the 2.5 million we're discussing today. This will accelerate growth, strategically introducing profitable brands in quarter 6 as we implement upgrades based on our cutting-edge R&D and efficiently scaling our production to capture market opportunities. The combination of these integrated strategies will yield significant and tangible benefits, ensuring a strong return on your investment. We project increased reputation with stakeholders, enhanced customer satisfaction, a positive revenue turnaround, profitability by quarter 5, improved brand judgment, expanded market presence, and notably superior production efficiency. To solidify our commitment to immediate progress, let's review the key actionable steps we have already implemented or actively pursuing. Our marketing strategy has prioritized increasing major ad placements and significantly boosting our social media presence. Concurrently, our sales channel strategy has involved the crucial step of hiring additional sales and service personnel and successfully opening stores in all of our planned test markets, establishing our physical footprint. In closing, we invite you to join us in shaping the future of cycling through a strategic investment in FO Tread Bikes. Thank you for your valuable time and consideration. FO Tread Bikes represents a unique opportunity to invest in our company with proven product market fit, a clear strategic vision, and a resilient plan for profitable growth. We are confident that a 2.5 million equity investment will accelerate our trajectory and deliver significant returns. I am now open to any questions you may have. Thank you.